So you've heard all the hype, right? The confusion, the wild stories about cryptocurrency trading? Well, you're in the right place. In the next few minutes, we're going to break down exactly what it is, where it all happens, and how traders try to navigate this totally exciting but, yeah, pretty volatile world.
You know the buzzwords. Bitcoin. And this is the one that went from some obscure corner of the internet to something your uncle brings up at family dinners. It's the OG, the one that kicked this whole thing off. And then there's this word, volatility. It gets thrown around all the time, right? It's what people use to describe those insane price swings. And honestly, it makes the whole thing sound super complicated and, well, risky.
But what if we could just cut through all that noise? What if we could get a really clear, straightforward picture of how crypto trading actually works? Well, that's exactly what we're about to do. Okay, let's dive into this.
First things first, where do we even begin? Well, before you can get your head around the trading part, you have to know what is actually being traded. So let's look at the digital assets at the heart of it all.
Okay, this is really cool because it shows the fundamental difference. The best way to think about it is this. Bitcoin is like digital gold. It was the first, and its main job is to be a store of value. But Ethereum, that's more like a global supercomputer. It's a whole platform for building things, like smart contracts, which are basically just bits of code that run automatically, or even entire apps that no single company owns. So for a trader, this is huge. Bitcoin's value is about digital scarcity, while Ethereum's value is often tied to how many people are actually using its technology.
All right, so you've got these digital assets, but where do people actually, buy and sell them? That brings us to the trading arena itself. All the action happens on something called an exchange. Just think of it like the stock market, but instead of trading shares of Apple or Tesla, you're trading digital assets like Bitcoin and Ethereum. It's the central hub for everything.
And here are some of the heavy hitters, the biggest names in the game. You've probably seen these logos around. Coinbase with its blue sea, Binance with those gold diamonds, Kraken. These are the massive digital marketplaces where millions of people are trading every single day. Now here's a really crucial point. A lot of the time, trading isn't about using US dollars. A huge amount of the activity is actually trading one crypto directly for another. We call this a trading pair. So you might swap your Bitcoin for Ethereum, or the other way around, based on how their values stack up against each other at that exact moment.
Okay, so we know what we're trading and where we're trading it. Now for the fun part, the how. Let's open up the Trader's Toolkit and see what's inside.
This is the moment trading stops being a guessing game and starts becoming a strategy. Traders use something called technical analysis. They're basically detectives, studying price charts and data patterns, looking for clues that might help them predict where the price is headed next. It's all about trying to make an informed decision. And these tools give you an incredible amount of control. A market order is the simple one. It's just you yelling, "Get me in right now at whatever the price is." A limit order is more precise. It's you saying, "Hey, I only want to buy if the price hits this specific number." And then there's the most important one for safety. The stop loss. That's your automatic eject button. It says, if the price drops this low, get me out automatically so I don't lose any more money. It's your safety net. Look, having the right tools is one thing, but it's only half the battle. How you use those tools with a smart strategy and a serious focus on safety is what really separates the pros from the amateurs. A lot of your strategy just comes down to your time frame. Are you a day trader, jumping in and out of trades all day long to catch tiny little price movements? Or are you a swing trader, holding onto your assets for a few days, or maybe even a few weeks, trying to ride a bigger wave? Two totally different ways to play the game.
And here's what makes crypto a completely different beast from the stock market. It never, ever sleeps. It is open 24 hours a day, 7 days a week, 365 days a year. That means prices are always moving, which creates nonstop opportunity, but also nonstop risk.
So in a market that literally never closes, how on earth do you manage that risk? How do you protect yourself?
Well, it really boils down to these three pillars. First, you use those stop-loss orders we just talked about. That's non-negotiable. Second, you figure out your position size, which basically means you never risk too much of your money on any single trade. And third, you stay on top of the news, because a single headline can send these markets flying in an instant.
And beyond just managing your trades, you have to be aware of the bigger landscape. This market can be wildly volatile. There are always security risks like hacks and scams you need to watch out for, and the rules from governments are changing all the time.
So what is the single biggest takeaway from all of this?
It's that success in this world is not about getting lucky. It's a discipline. It's about combining that skillful analysis to find opportunities with rock-solid risk management to protect yourself when you're wrong.
And that really leaves us with a big question, doesn't it? When you combine this powerful tech, the 24/7 global access, and this high-stakes strategy, it really feels like a new frontier. But is this disciplined, non-stop trading the blueprint for the future of finance? Or is the volatility just so intense that the risk will always be too high for it to ever truly go mainstream? That, right there, is the multi-trillion-dollar question everyone is watching.